Here is your rewritten version in English. I have preserved the exact same structure, length, flow, tone, paragraph breaks, cliffhangers, examples, questions, calls to action, and overall message. Only the wording, phrases, vocabulary, sentence construction has been rephrased to make it original while keeping the meaning and impact identical. Tonight, I want you to visualize something that feels deeply unsettling. You step inside a supermarket, the shelves stand completely empty. No rice, no milk, no loaves of bread. That's troubling, yet it's logical. A shortage leads to vacant shelves. Now imagine a far more ominous scene. A delivery truck reverses up to the loading bay. The rear door swings open. It's packed full. Pallets rise all the way to the roof. Then the manager walks up and declares, "I'm not selling you a single item, and I'm not purchasing anything from you either." In a healthy economy, someone is constantly purchasing. Someone is constantly selling. Typically, both at once. That continuous exchange is the pulse. When that pulse halts, the issue isn't simply limited availability. The real issue is that the market's nervous system has malfunctioned. And that malfunction has now surfaced in the U.S. physical silver supply chain in a manner more direct and stark than anything I've encountered before. What unsettled me most on my monitor wasn't a surging price chart. It wasn't some explosive social media post. It wasn't a sensational news title. It was an ordinary, unremarkable wholesale pricing list from one of the leading bullion distributors. This is the intermediary tier that connects refineries to the retailers you deal with directly. A single page, 2 columns, and a statement that echoes more powerfully than any graph. The offering column looks desolate. American Eagles, unavailable. Canadian Maples, unavailable. Generic bars, unavailable. Bulk generic rounds, unavailable. You probably anticipated that section. Most people tracking silver saw that coming, but the purchasing column is where things truly become surreal. Several listings carry a term that should never appear during explosive demand. No bid, not a reduced bid, not an offer well below spot, simply no bid. Meaning we aren't providing a quote, we aren't interested in acquiring, we won't even respond to your inquiry. So before diving into technical analysis, projections, or wishful thinking, we must confront one brutally straightforward question. How is it possible for a market to be completely depleted, yet simultaneously decline to purchase the identical commodity? How can the supply network announce zero inventory available while also refusing to accept your material? This isn't routine. This isn't a small glitch. This is a core warning from the system itself. And the warning reads clearly, the challenge has shifted away from demand. The challenge now centers on financing. Quickly, because this matters, tap subscribe if you haven't already, and leave a short comment. Something as basic as Oriana works. It only requires a couple of seconds, and it signals to the platform that this content holds value. Now, let's pause and unpack this step by step. When folks see no bid, they often conclude the metal lacks interest. That interpretation is precisely backward in strained conditions. No bid frequently signals that the purchaser is eager yet lacks the necessary capital. It signals a breakdown in liquidity. Liquidity functions as the unseen lifeblood of any marketplace. It's invisible during normal operations. Its absence triggers alarm. Here's the harsh reality. The wholesale segment of the precious metals trade isn't structured like a fortress. It operates more like an assembly line. These businesses don't act as patient holders. They function as transport and distribution operations. They acquire metal, offset price exposure, dispatch it, and cycle again. Profit derives from the margin between buy and sell plus high throughput, not from long-term appreciation. Margins stay narrow. Balance sheets remain substantial. Therefore, when silver surges sharply upward, the commodity gains worth, yet the enterprise grows increasingly vulnerable. That contradiction is exactly what the document reveals. Depleted on the sales column due to sourcing difficulties. No bid on the acquisition column due to inability to fund ongoing purchases. For a straightforward comparison, picture a cab service with endless riders waiting, yet no gasoline available. The vehicles remain parked. Desire becomes irrelevant if the system cannot operate. Now comes the puzzle that puzzles many. How can dealers fail financially during a roaring bull run? How can an enterprise dealing in silver falter precisely when silver climbs aggressively? The modern framework turns harsh here, and the explanation lies in risk management via derivatives. Most major operators are prohibited by creditors, company guidelines, or compliance teams from maintaining naked physical positions. The reason? Prices might decline between acquisition and disposal. Should a distributor purchase millions of ounces and silver falls several dollars before resale, that modest decline could erase 12 months of earnings. Thus, the conventional approach neutralizes exposure. Acquire the tangible asset, then establish an opposing position in futures. The reasoning appears sound. Should prices fall, the physical depreciates. Yet the futures positioned profits. The offsets balance. The operation remains steady. That's the intended design. Reality, however, disregards design. When prices advance rapidly, especially violently, the futures position incurs heavy losses. Those losses require settlement in actual currency daily. This element escapes most observers. Appreciation in physical holdings stays largely on paper until liquidation. It exists as a balance sheet entry. Losses on the futures side, however, hit immediately via margin requirements. Each trading day, the clearinghouse revalues the position and calls for additional funds. Hard cash, transferred promptly, no delays permitted. You might sit on enormous unrealized gains in metal while simultaneously wiring out enormous sums to cover the hedge. Without sufficient liquid reserves, you aren't merely inconvenienced, you cease to exist as a going concern. That mechanism explains how escalating values can bankrupt participants. You might wonder, can't they liquidate the physical and unwind the futures? Certainly, under stable circumstances. Under turbulent conditions, liquidating physical isn't immediate. Material sits in transit, committed allocations, processing lags. Even upon sale, proceeds may arrive too late for the margin deadline. The exchange refuses to pause for logistics timelines. Consequently, the protective hedge morphs into a relentless cash drain that empties the enterprise. Once reserves vanish, one brief phrase alters everything. No bid. Because absent check-writing capability, acquisition from the public stops, regardless of eager sellers lining up. Regardless of overwhelming desire, the apparatus requires currency to function. Let's ground this further. Consider a modest local coin store. They purchase from individuals, they vend to walk-ins. When they require liquidity refreshment and inventory turnover, they offload to the wholesaler. That wholesaler serves as the safety net, the final exit ramp. When that safety net withdraws bids, the local store's vulnerability skyrockets. If they acquire your silver now, can they offload it soon? Should the response shift to uncertain, self-preservation kicks in, spreads expand. Acquisition offers drop, purchasing decelerates, or halts completely. That's the contagion pattern. It originates at the lending institution, spreads to the wholesaler, infects the storefront level, eventually reaches the individual holder. This explains my repeated emphasis. This transcends mere pricing dynamics. This concerns foundational infrastructure, and infrastructure disruptions alter conduct rapidly. Allow me to add one additional aggravating factor. Lending institutions detest turbulence. Where you perceive strength in silver's ascent, a credit risk manager perceives hazard. As volatility intensifies, lenders impose steeper discounts. They advance less against identical collateral due to fears of abrupt reversals. There exists an even more elementary arithmetic constraint. Credit facilities typically carry fixed limits. A distributor enjoying a $100 million facility can finance substantial volume at $25 per ounce. At 95, however, that identical facility supports considerably less volume. Supply chain throughput contracts as values climb. The conduit narrows? Now, let's address the mental snare mainstream outlets will likely deploy. They'll point to no bid and proclaim, look, silver lacks interest. That constitutes narrative manipulation. Liquidity disruptions cause failed exchanges. Failed exchanges can masquerade as absent desire to observers unfamiliar with operational mechanics. Desire, however, isn't the culprit. The culprit involves capacity to finance and finalize transactions. It resembles appetite versus actual settlement ability. A dining establishment may face queues stretching outside. Should the payment terminal fail and the proprietor lack cash on hand, service halts. That doesn't indicate food lacks appeal. It indicates transaction infrastructure has collapsed. This observation opens the door to an even more alarming consequence. Should formal redemption channels grow inconsistent, converting physical silver to currency via conventional paths becomes less reliable. That doesn't diminish silver's intrinsic worth. It elevates silver toward genuine monetary status, inherently valuable yet intermittently illiquid via institutional intermediaries. When intermediaries falter, markets respond characteristically. They circumvent obstructions. They shift toward direct exchanges. They become informal. They localize. History reasserts itself here. Across millennia, silver required neither wholesale networks nor futures platforms to establish value. Value emerged because communities honored it. Pricing arose through direct human agreement, not automated systems. When paper-based mechanisms strain, that ancient mechanism revives. Let's examine the emerging dual pricing phenomenon, as evidence already appears. One price exists on monitors, another exists in actual transactions. Monitor price reflects future settlement. Transactional price reflects genuine payment for delivered metal under pressure. When distribution channels jam and rivalry diminishes, transactional price frequently outpaces monitor price. Transactional price incorporates a reliability surcharge, compensation for certainty that the asset exists physically, arrives promptly, and isn't merely a contractual obligation. Should wholesale infrastructure fracture, that reliability surcharge escalates. Combine that concept with the subsequent development, market concentration. Crises routinely compress smaller participants. Independent retailers rely heavily on cash circulation. Unable to consistently cycle inventory or sustain liquidity, they adopt protective postures. Some shorten operating hours. Some cease acquisitions. Some restrict sales. Some shutter permanently. Reduced participant numbers erode competition. Diminished competition produces expanded margins and elevated surcharges. Thus emerges a landscape where acquisition costs soar while disposal offers shrink. Retailers embed uncertainty and scarcity into pricing. Liquidity deteriorates even as underlying asset worth strengthens. I want to insert a warmer note here. I recognize many viewers follow silently. Should you have navigated this period successfully, executed prudent decisions, expanded operations, eliminated obligations, strengthened reserves, consider sharing a modest victory in comments. It bolsters others' resolve. It fosters a community rooted in advancement rather than anxiety. One additional point, delivered plainly. By now, a subscriber-exclusive recording should be available, compiling recent developments alongside more detailed examination rarely shared publicly. For that richer perspective, consider membership and review it. Membership also demonstrates genuine engagement during critical periods, returning to operational details, because we haven't yet reached the gravest self-reinforcing cycle. The gravest cycle activates when impaired redemption pathways curtail secondary supply. Consider metal re-entry sources beyond primary extraction. Reclamation, family heirlooms exchanged, inherited collections liquidated, personal holdings cashed out. That material flows to retailers, undergoes processing, re-enters circulation. Reclamation volume relies on an operational intermediary network. Should intermediaries acquire less due to financing constraints or clearance issues, reclamation diminishes. One relief mechanism vanishes, transforming scarcity from cyclical to embedded. Embedded scarcity prompts holders to retain rather than release. Circulation velocity declines. Reduced velocity amplifies even modest incremental desire, driving sharper advances. That acceleration fractures fragile components. The document you viewed doesn't conclude the narrative. It marks the initial evident fracture. I pose a question valuable for both engagement and practical insight. Suppose tomorrow your nearby retailer states, "We aren't acquiring presently." How would you respond? Retain position? Seek alternate outlets? Explore direct exchanges? Or feel alarm? Reflect on your instinctive answer now. Preemptive clarity preserves composure during actual events. Second inquiry. Do you view authentic silver valuation as the monitor figure, or as realizable exchange value within your community? Dwell on that distinction briefly. Your response discloses whether you approach this as a speculator or as someone bracing for institutional instability. I mentioned suspense elements earlier. Here comes another. Wholesale breakdown creates serious difficulty. Greater peril lies ahead. Divergence between paper settlement and physical reality so extreme that published figures lose relevance for tangible metal. How might that unfold? Paper clears, absent delivery. Settlements occur financially. Physical allocation tightens severely. Surcharges reach levels constituting separate marketplaces. Anyone familiar with official versus informal pricing for scarce goods already grasps the pattern. I'm not claiming universal realization yet. I'm stating enabling conditions have emerged visibly. That reality merits serious consideration from attentive observers. Shifting briefly to a frustration I've carried lately, it connects directly here. Emotional market phases spawn imitators and fraudsters. They duplicate formats, reuse visuals, saturate feeds with minimal effort clones. My position in one sentence, I'm actively identifying and addressing channels that plagiarize material and mislead audiences. Supporting that effort remains straightforward. Subscribe and comment once more. Even repeating John A.G. suffices to help platforms separate authentic from duplicated content. Concise, direct, impactful. Continuing onward, because the upcoming segment dismantles common misconceptions. Many presume elevated pricing guarantees robust earnings for intermediaries. Intermediaries, however, thrive on margin capture and finance turnover, not absolute levels. Correct directional conviction paired with liquidity timing failure can still prove fatal. That explains why current conditions transcend simple directional labels. They generate simultaneous promise and hazard. Promise for holders, possessing free and clear physical without debt. Hazard for those dependent upon intermediaries, assurances, synthetic positions, immediate convertibility. Speaking directly to long-term accumulators, momentarily. Should you maintain tangible holdings, your foremost responsibility isn't constant monitor surveillance. Your foremost responsibility involves safeguarding pathways and flexibility. Pathways mean awareness of viable acquisition and disposal options. Flexibility means retaining discretion over timing and method rather than compulsion. Plumbing disruptions elevate pathway security and discretionary control above numerical forecasts. Practical steps include cultivating contacts, remaining observant, avoiding reactive decisions, monitoring margin differentials, observing intermediary conduct beyond numeric displays, recognizing that vigorous bullish signals can coexist with provisional channel illiquidity. That combination isn't inconsistent. It characterizes pressure environments. Inserting another brief aside, since several requested similar elements, returning to core narrative. Virality potential stems from striking fundamental market anxiety. Transaction capability. Desire for appreciation alone falls short. Desire includes option to mobilize holdings at chosen moments. A leading distributor simultaneously depleted and unwilling to acquire triggers. Inevitable follow-up question: what occurs should this pattern propagate? Consider two paths. Path 1. Constraint remains contained. Major distributors obtain additional facilities, streamline procedures, resume quotations. System persists with elevated surcharges and extended timelines. Path 2. Constraint expands. Additional distributors curtail quotations. Retail outlets lose disposal channels. Retail postures harden. Redemptions decelerate. Reclamation volumes contract. Surcharges surge dramatically. Direct exchanges proliferate. In Path 2, genuine pricing migrates beyond conventional institutional frameworks. Which path holds greater probability? I won't claim predictive certainty, yet market behavior under duress follows recognizable stages. Initial denial, subsequent attribution, followed by restriction, ultimately adaptation. Restriction phase may already dominate. Adaptation phase births emergent structures. The concealed driver of adaptation remains confidence. Confidence underpins quotation existence. A quotation transcends numeric expression. It constitutes commitment. I possess settlement capacity. Credit constriction plus margin drainage erodes confidence. Eroded confidence eliminates quotations. Should your focus remain solely on projected dollar multiples, the profounder narrative escapes notice. Profounder narrative involves fracturing confidence in institutional settlement mechanisms. That reality elevates current developments beyond graphic interpretation.